Here is a number that destroys the last 30 years of economic textbooks: 5.8%. That is the average wage hike demand being finalized by Japan's biggest unions this week. The era of cheap Japan isn't just ending, it's being violently repriced.
5.8%? Alex, that's not a wage hike. That's an inflation adjustment on steroids. Welcome back to Asia Tech Macro. I'm Maya, looking at how startups are going to survive this labor cost explosion. And with me is Alex, who I assume is already shorting Japanese exporters.
Not shorting, but definitely hedging. The Shunto, Japan's annual spring wage offensive, is heating up, and the leaks coming out of the negotiation rooms are wild. For decades, Japanese unions asked for 2% and settled for 1%. Last year, they got 3.6%. But this year, the momentum is completely different.
I saw the report from Rengo, Japan's trade union confederation, this morning. They are demanding a weighted average increase of nearly 6%. And the crazy part? Big companies like Toyota and Hitachi aren't laughing them out of the room. They're nodding.
They have to nod. The labor shortage in Japan is critical. We talked about TSMC hiring engineers in Kumamoto last week, but it's everywhere. Convenience stores, logistics, construction. If you don't pay, you don't operate. But here's the macro implication that most people miss. The Bank of Japan needs this.
Right, the virtuous cycle. Governor Ueda has been saying for years that he can't normalize interest rates until he sees sustainable wage growth. Well, 5.8% is sustainable. It's actually aggressive. Does this mean a rate hike in March is a lock?
It makes a March or April hike almost a certainty. The market is currently pricing in a move to 0.5%, but if these wage deals get signed in mid-March, the BOJ might have to go faster to stop the yen from strengthening too quickly. Wait, did I just say stop the yen from strengthening?
You did. That sounds like science fiction after the last 3 years. But speaking of pricing anomalies, something very strange is happening in Shenzhen. The black market price for Nvidia chips, which has been skyrocketing for 2 years, just crashed.
Crashed is a strong word, but the data is undeniable. I was looking at a channel check report from a boutique research firm in Hong Kong. In January, a smuggled Nvidia H100 in Shenzhen would cost you about $45,000. This week, it's trading closer to $32,000. That's a nearly 30% drop in a month.
Why? Did the U.S. lift export controls? Definitely not. Did the smugglers find a bigger boat?
No, it's actually a supply and demand shock. On the demand side, Alibaba and Tencent are reportedly slowing down their black market purchases because, wait for it, Huawei's Ascend 910C is actually working.
The Huawei chip is actually good? That's a massive geopolitical pivot if true. I remember back in 2024, everyone said it was years behind.
It was, but necessity is the mother of invention and massive state subsidies. The report suggests the Ascend 910C, produced by SMIC, is now achieving about 80% of the performance of an Nvidia A100 in certain large language model training tasks. It's not an H100 killer, but it's good enough for a lot of workloads.
So Chinese tech giants are switching to domestic chips not just because they have to, but because they are finally viable alternatives. That destroys the premium for smuggled Nvidia chips.
Exactly. And here is the supply side shock. The U.S. government's latest crackdown on straw buyers in the Middle East and Southeast Asia is working. They are seizing more shipments before they even get to China. So you have falling demand from big tech and a riskier supply route. The arbitrage is closing.
That is fascinating. The black market is the ultimate real-time economic indicator. But speaking of closing arbitrages, let's talk about Singapore. The city-state is basically putting up a closed for dodgy business sign, and it's sending shockwaves through the world of Chinese wealth management.
You're talking about the aftermath of that massive money laundering scandal last year, the one with the $1 billion in seized assets, luxury cars, and bottles of Macallan 64.
The Fujin gang case, it was enormous. Well, the regulatory backlash is finally here. The Monetary Authority of Singapore, MAS, just issued new guidance to family offices and private banks. Basically, the Know Your Customer, KYC requirements, just went from strict to forensic.
I heard from a private banker friend in Singapore that they are now required to verify the source of funds going back generations for certain high-risk clients. If you can't prove how your grandfather made his money in 1985, your account opening gets rejected.
It's a zero-risk policy, and it's causing a massive capital flight away from Singapore. Where is that money going?
Dubai. The DIFC, Dubai International Financial Center, is welcoming Chinese family offices with open arms. I saw data from Henley & Partners suggesting a 40% increase in inquiries from Chinese high-net-worth individuals for UAE golden visas in Q4 2025.
So Singapore's loss is Dubai's gain. It's the great wealth migration of the 2020s, shifting from East Asia to the Middle East. But Alex, devil's advocate here, isn't Singapore shooting itself in the foot? They are giving up billions in assets under management to maintain their reputation?
They are. But that's the point. Singapore sells trust. If they become known as a laundromat for dirty money, their entire value proposition as the Switzerland of Asia evaporates. They are sacrificing short-term flows for long-term stability.
That's a mature, confident move. Contrast that with Dubai, which seems happy to be the Cayman Islands of the desert for now.
Exactly. Dubai is the new Wild West of global finance, while Singapore is the gated community. And speaking of unexpected shifts, let's pivot to our contrarian corner.
All right, Alex, what is the consensus truth that you are ready to dismantle today?
The consensus is that Japanese companies cannot pass on higher costs to consumers. We've heard it for 30 years. Japanese consumers are price-sensitive, deflationary mindset, any hike kills demand.
And you think that's wrong?
I think that in 2026, we are finally seeing the acceptance of inflation. The 5.8% wage hike we talked about changes everything. When people feel richer, they tolerate higher prices. The companies that are raising prices aggressively right now, fast retailing, Toyota, even the local ramen shops, are actually seeing revenue growth, not volume collapse.
So the price hike taboo is broken? That is a huge cultural shift. It means margins for Japanese companies could actually expand for the first time in decades.
Precisely. The contrarian bet is to buy the companies with pricing power, not the cost cutters. The deflation winners, like discount stores, might actually underperform the inflation beneficiaries, like high-end services and premium brands.
Interesting. Buy the price hikers. Okay, let's wrap this up with the action items. What should our listeners actually do on Monday morning?
Action item 1, long Japanese banks. With the 5.8% wage hike all but guaranteed, the BOJ has the green light to normalize rates faster than the market expects. Mitsubishi UFJ, MUFG, and Sumitomo Mitsui, SMFG, net interest margins are about to explode higher.
Action item 2. If you are in the semiconductor hardware trade, be careful with Nvidia suppliers exposed to the gray market. The crackdown is real, and Chinese demand is softening due to domestic substitution. The infinite demand thesis has a crack in it.
And action item 3. For our high net worth listeners looking for a plan B, diversify your jurisdiction risk. If Singapore is getting too tight on KYC, look at Dubai or even Hong Kong for certain asset classes. The one hub strategy is dangerous in 2026.
Great insights today, Alex. We covered the historic Japanese wage shock, the crash in black market Nvidia chips, and the great wealth migration from Singapore to Dubai.
The rules of the game are changing every week. Next week, we're doing a deep dive into the Southeast Asian unicorn IPO pipeline and why Grab is finally profitable.
I'll bring the S1 filings, you bring the skepticism.
Deal. Thanks for listening to Asia Tech Macro. Don't forget to subscribe on Spotify or Apple Podcasts and leave us a review.
Stay data-driven. See you next week.
Bye.
Bye.